OpenAI delayed its IPO, one of the most anticipated listings of the decade, potentially pushed all the way to 2027. And within days, the selling reached your portfolio. The biggest names in tech, the ones sitting in nearly every index fund. They didn't miss earnings, nothing broke, yet they fell anyway. What just happened is going to hit your portfolio. And most investors are reading it completely wrong, because they think this is one company's problem. It isn't. But the headline isn't the story. The mechanical reason behind it tells you what's coming for the rest of the market. By the end of this video, you'll understand why this freeze is keeping your portfolio alive for now, and what kills it later. Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. But before we start, if you don't know me, my name is Martin. I'm not in the rooms where these private valuations get set. Almost no one is. But I've spent years teaching myself how those rooms actually work, how a company decides what it's worth, and what happens when it finally has to prove that number in public. That gap between the price on paper and what the market will really pay is the whole story here. Anyway, before we get to the IPO, we need to understand one simple idea, because the headline makes no sense without it. A private valuation and a public valuation are two completely different animals. Let me explain real quick. When a company is private, a handful of giant investors sit in a room and agree on a valuation number. That's it. OpenAI's last private round in March valued it at around about $852 billion.
So OpenAI has just closed a $122 billion round and an $852 billion post-money valuation after adding another $12 billion tranche from venture investors.
But that number isn't real money changing hands across an open market. It's a story a few insiders agreed to tell each other. A public valuation is different. That's where millions of regular buyers and sellers with actual cash vote every single second on what the thing is worth. And here's the bit I want you to remember because it pays off later. A private valuation needs a few believers. A public valuation needs liquidity. It needs an ocean of real dollars deep enough to absorb the price. So OpenAI is now demanding $1 trillion to go public. Sam Altman reportedly calls anything less a non-starter. That's a 37% premium over their own private round from just a few months ago. And against revenue, it's absolutely bananas. OpenAI's run rate is around $25 billion a year, which sounds huge, right? Except a $1 trillion price tag means they want roughly 40 times revenue. Traditional software trades at maybe 8 to 12 times. Even Nvidia, the absolute golden child of this whole mania, sits at around 21 times. So OpenAI is asking the public market to pay nearly double the richest multiple in modern tech history. And the public market just quietly said, yeah, no. Can't talk about IPOs without mentioning the following. On June 12th, SpaceX pulled off the largest IPO in history. It raised around $85.7 billion, nearly triple the old record held by Saudi Aramco.
Elon Musk is the first trillionaire in human history. Just minutes ago, SpaceX began trading and immediately jumped by more than 20%. And that has made Musk a trillionaire. $1 trillion. That is a 1 with 12 zeros after it. If you spend $1 million a day, it will take you more than 2,700 years to spend it all. Musk celebrated the first day of trading the company that makes up most of his wealth this morning.
And at first, it worked beautifully. It was listed at $135, rose to a peak of $225 within 4 days. Then the institutions and the bond market actually looked under the bonnet, and by late June, the stock had collapsed by over 30% from that peak. So what did the smart money see that the retail crowd buying at $200 didn't? They saw a cash furnace. Let me explain what I mean by that. SpaceX did $18.7 billion in revenue last year, but it lost $4.9 billion. And in the first quarter of 2026 alone, it burned through $4.3 billion. That's nearly the entire previous year's loss in 3 months. The only part actually making money is Starlink. Everything else is just devouring cash, with AI spending alone now eating 76% of all their capital expenditure. So the public market didn't refuse to provide infinite exit liquidity because it's stupid. It refused because it could read a balance sheet. And that is precisely why OpenAI is terrified to list. Because OpenAI is an even bigger furnace. They're projected to burn around $27 billion this year. In Q1, they torched $3.7 billion on just $5.7 billion of revenue. So now we get to the real point, and this is where it gets properly dangerous. When a giant company refuses to list, it doesn't just hurt itself. It jams the entire financial system like a cork in a bottle. Because venture capital and hedge funds have hundreds of billions locked up in these private shares. Estimates put it at $400 to $700 billion of equity, waiting for an exit window that just slammed shut. And here's the bit nobody connects. Without an IPO, those funds can't cash out. They can't return money to their investors, and they can't free up capital. So when one of their funds gets squeezed, what do they sell? They can't sell the frozen private stuff, can they? So they sell the one thing they can sell instantly. Their liquid public tech stocks. Meta, Amazon, Microsoft, all of it. They dump the good stuff to cover the frozen stuff. And that, right there, is why the NASDAQ is down around 6% from its June peak, while every single one of the Magnificent Seven fell at least 8% this month. And watch what the smart money is actually doing, not what they're saying. Yale University cut its AI exposure from 35% to 22%. SoftBank's $6 billion margin loan stalled because lenders can't even price a stake in a company with no public benchmark. The people closest to these companies are de-risking, while the public is still being told the AI rocket only goes up. Now look, this is the part where I have to be honest with you, because I'm not here to sell you a fairy tale. I could be wrong about all of this. Plenty of analysts call this a healthy gut check, not a structural bust, and they've got a point. OpenAI's revenue genuinely doubled in a year. Starlink genuinely prints cash, and Anthropic, OpenAI's main rival, just hit a $965 billion valuation and is projecting an actual operating profit of $559 million. So maybe the fundamentals grow into these prices. There's also a real chance the Fed holds firm. Money market funds keep paying 5% risk-free, and nobody bothers rotating into stocks at all. I've been early to these calls before, and I'll probably be early again. Nobody can time this stuff exactly, so don't try. Anyway, let me tell you what I'm actually doing, because this is where it gets interesting. I make sure I avoid panic selling anything. Ironically, this IPO delay might be the very thing stopping an immediate crash. Think about it. If a $1 trillion IPO had landed today, it would have sucked every last dollar of dry powder off the sidelines to fund it. That would have suffocated the rest of the market completely. We've seen this happening many times in history. But by delaying, that cash stays in the system, and there's a lot of it. There's around $8 trillion sitting in money market funds right now. That's the fuel. By not lighting it on fire for one mega listing, the system keeps a buffer. So my read is that we could actually see a final, aggressive melt-up in traditional equities before this liquidity cycle truly turns. There's even a mechanical trigger coming. SpaceX joins the NASDAQ 100 on July 7th, which forces passive funds to buy around $7.3 billion of it, regardless of fundamentals. So here's my playbook. I'm staying long the quality names for now, but with my finger near the exit. I'm watching credit conditions and these private exits like a hawk, because the second that dry powder starts draining, the music stops. I'm not chasing anything that's already pumped 200%, and I'm definitely not buying a cash furnace at 100 times sales. No leverage, long time horizon, and patience. Because the smart money already knows the public market is running out of the liquidity to absorb these trillion-dollar dreams. The delay just bought everyone a little more time. OpenAI staying private isn't a sign of strength. It's a confession that the price the public will pay is a long, long way below the price they're demanding.
There are question marks that have been well reported about pricing of their models. There are question marks about the reality of what the balance sheet would look like in the future for these type of names. So this is a real concern, and it's not only for OpenAI, it's for Anthropic as well as the hyperscalers.
So enjoy the melt up if it comes, but don't fall in love with it. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.